when they hear note investing, they often think about, oh, hey, I've got a property that I'm going to sell on owner financing or sell on terms to somebody because I couldn't sell it traditionally or the borrowers can't qualify. And that's an aspect of creating notes on owner financing. I'm on the other side of it.
How does that usually get structured? Like, are you... well, I don't need to give you examples. Why don't I just let you tell us? How does that get structured? Or maybe there's many different ways. I don't know how that typically works.
So since we're buying from banks, we're buying the receivable. The property doesn't change hands. The borrower is still in the property and they still owe what they owe.
If you're able to salvage 70% of the time on people that haven't paid for 90 days, it's a significant amount of time to have not paid their mortgage. How do you then get that many of them turned around?
Hey, you can actually move back into your property. Quit paying the rent to somebody else, move back in and pay your mortgage to me, and let's keep it back on track.
Hey everyone, I'm Jason Balara, and this is the Know Your Why podcast. Today I'm here with Scott Carson. Scott has been a full-time real estate investor for over 20 years and has focused in the last 17 years on buying distressed debt on residential and commercial properties across the country. Scott, I as I mentioned, I'm going to let you tell your story, but this is not a topic that we have talked about a ton on the podcast, so I'm really excited to learn more and get your take. So thank you for coming on the show today. Thank you for taking the time out to talk with me.
Well, honored to be here, man. And it's a niche within the real estate investing world of what I do, and done it for 15, 16, 17 years now. It's hard to believe. Time flies when you're having fun, right?
Yeah, sure. Well, tell us about yourself. Tell us about your background, kind of what got you to where you are today. And then I'm sure I'll have lots of questions.
Yeah, no problem. So I'm in Austin, Texas, the keep it normal, not keep it weird side of town. But like I said, been a real estate investor, entrepreneur for over 20 years. I like to focus on kind of the marketing side. Has always set me apart. But I will say kind of my origin story started off on the rocks as a real estate investor. Like many folks, I read Rich Dad, Poor Dad and loved the concepts of that and thought, bought my first house, and my realtor was like, you guys got great credit. You should buy some more investment properties. I was like, yeah, I know how to fix stuff up. I grew up in a hardware store, in South Texas. And so we bought 2 other investment properties, and in a matter of about 90 days after buying those properties, I was laid off from my 6-figure job. And then my 2 tenants were laid off from their job at a computer company that rhymes with hell. Okay. And so I always joked that I was a distressed borrower pretty fast in my investing career. Fortunate for me, I got rid of the 2 investment properties without losing too much face, kept my primary residence, and then licked my wounds for roughly about a year before I got into starting a mortgage company with a buddy of mine that I'd known for years. And we hooked up with a couple of real estate investors that were traveling the country teaching creative financing and teaching on these big summits and conferences, stuff like that. And I was doing mortgages to real estate investors and did that for a few years. Had a great time traveling basically every other week and just absolutely soaking up as much information as I could while doing mortgages. And then when everything hit the fan in 2008, I left the origination side and started calling banks and asset managers. And that's basically all that I've done since 2008 is buy distressed mortgage debt with the goal of working to keep people in their houses, because I empathize because I was once there before back in the day. And that's kind of what I've done and leverage video and podcast, stuff like that, so that I'm known as the note guy across the country, basically.
Yeah, no, it's like you said, it's a niche within real estate investing. And I think that's actually one of my favorite things about real estate investing is that there's so many different, like almost infinite ways to be involved. So, and the origin story with a experienced in having perhaps a distressed note sort of sends you down that path. But tell us a little. I guess let's just start with maybe a definition or how you classify a distressed note. We'll start there so people listening kind of understand exactly what it is you invest in, and then I have more about, kind of your strategy.
Sure, no problem. So most people are familiar with like buying a property and going and getting a mortgage on it, their primary residence and stuff like that, or getting a hard money loan. And that's what most people do. When they hear note investing, they often think about, oh, hey, I've got a property that I'm going to sell on owner financing or sell on terms to somebody because I couldn't sell it traditionally or the borrowers can't qualify. And that's an aspect of creating notes on owner financing. I'm on the other side of it, where I actually will buy the debt from note holders who have created mortgages, or I actually prefer I buy these mortgages direct from banks and hedge funds and lending institutions where the borrower has not paid in usually 6 months or longer. And that's what defines a distressed mortgage, is that anytime somebody's behind 90 days or longer, it's distressed. And so we get these lists from banks, lenders that we are able to cherry pick, and then we'll buy that at a discount with a goal to either I say rehab the borrower, where we try to get them back on track, making, doing a payment plan, a modification, forbearance. The fact that we buy these mortgages at a big discount gives us a lot of flexibility to work with a borrower. If they won't play ball, then since we're the bank and the lender, and I don't run a charity, pay, stay, then we have the same rights the bank does to go and take the property to foreclosure and either A, sell it at the foreclosure auction, or B, take the property back and then fix it up, sell it off, whatever we want to do. And that's kind of the definition. And 70% of the time, too, we're actually able to keep people in their houses, which is a good thing.
Yeah.
I actually make more money. It's a better yield. It's less work by just managing the paper and being the lender for the most part. So that's kind of how I defined a non-performing note. Somebody who hasn't paid in a while, that the bank looks at as a problem child, problem borrower, that we can step in and get enough of a discount that if it makes sense for us to keep them in the house, we will most of the time. Now, of course, we'll buy some stuff, kind of like your previous guest from a couple episodes ago, Bob Diamond, talked about buying some foreclosure auctions. We're actually selling the debt at the foreclosure auctions because we're the bank and going that route. But sometimes we'll take a property back and fix it up and sell it off and go from there, or keep it.
So, 70% of the people stay in their homes, which I think is actually argues that this is a very valuable service for the distressed borrower, if you will. Your bio says you refer to it as rehabbing borrowers. I kind of have two questions around that. You said you have to buy the debt at a discount. So how does that usually get structured? Like, are you well, I don't need to give you examples. Why don't I just let you tell us? How does that get structured? Or maybe there's many different ways. I don't know how that typically works.
So since we're buying from banks, we're buying the receivable. The property doesn't change hands. The borrower is still in the property, and they still owe what they owe. So give you an example. They take out a $200,000 mortgage on a $200,000 house, but they fall on hard times or something like that. And 6 months later, they owe $215,000, $220,000 on the property. They're upside down, right? Well, we'll buy, if they haven't paid in 6 months, we'll try to buy that note somewhere around, 50, 60 cents on the dollar.
Okay.
And the bank gets their money. They go off. They don't have to foreclose. They don't have to go through the longer foreclosure time frames of some sort. They can go out and leverage that money 15 to 20 different ways to make their money back. Because for every note that's on a bank's portfolio, it costs them like six figures in fees and interest that they're not collecting. Okay. And this is also why if you've ever had a mortgage and you ever were late by more than 7 days in your mortgage, why the post office guy is knocking on your doors with a certified letter, your phone's ringing off the hooks. Hey, are you going to pay us? What's going on? That kind of stuff. Yeah. And so we try to negotiate back and forth with the bank, depending on, what's the interest rate on the underlying mortgage, what's the situation with the borrower, what's the value of the property, what's going on in that market. Some markets are better or not, so there's a variety of due diligence that we do, not only on the property, but the actual borrower and the actual loan file to make sure everything is all the T's are crossed and the I's are dotted for the most part. So it's a back and forth process. We'll make an offer, the banks may accept it or may counter, we may counter back. Like I'm getting ready to close on a deal just north of me here in Georgetown, Texas, that we went back and forth 5 times, countering back and forth to finally get a point that made sense for me. Otherwise, I may make 50 offers on a list that we get from a bank, knowing I'll probably only end up with 5 or 10 of them. But the idea is that the more offers you make, the more you get accepted. And going back, if they accept my offer too, which they have, and I find in my due diligence period that the property's in worse condition, they owe less than the actual numbers show, there's a huge tax bill, or it's just in a rougher part of town, to take a look at that I don't want to get into, I have the right to basically cancel my offer and just walk away and go on from there. Note investing is a little bit longer process than buying a property and fixing up and flipping them for the most part, because every state has a different foreclosure time frame. Like here in Texas, it's really 30 days to foreclose, whereas areas like New York take 3 years to foreclose, or New Jersey takes 2 years, or Florida is about a year. We don't buy in New York or New Jersey, but we do buy in states that can take up to a year to foreclose. So we're buying about 20, 30 states. And people always ask me, well, how do you do that? Do you fly out and take a look at everything? No, we use a tool called Google. We use the local vendors to go out and be our eyes and ears and pull the data on it and then go from there.
Yeah, makes total sense. When you're rehabbing these borrowers, what is that? I'm sure it's individual situations, but I mean, what does that kind of look like most of the time? If you're able to salvage 70% of the time on people that haven't paid for 90 days, that like it's a significant amount of time to have not paid their mortgage, knowing that something like a foreclosure or losing their home could happen. Like how do you then get that many of them turned around? To me, that sounds like quite a high success rate on that.
Are you planning a remodel or construction project? Overwhelmed by the process? Over budget? Extended timelines? Strained relationships? We are all too familiar. At Lark Construction Services, we help homeowners and business owners take control of their construction journey, from reviewing bids and contracts to catching red flags before they become costly mistakes. Our Clarity Audit is a one-on-one expert review of your plans, estimates, or current progress, giving you the peace of mind and a defined action plan to move forward with confidence. Don't let confusion lead to costly errors. Visit larkconstruction.com and schedule your free call today. Lark Construction Services, saving you time, money, and stress.
Well, I mean, if it's occupied, it's a great thing. You're never going to, if somebody's already moved out of the property, you're never going to get them come back in the house.
Right.
I mean, we've had that happen like twice with the thousands of deals we've done. Like, hey, you can actually move back into your property. Quit paying the rent to somebody else, move back in and pay your mortgage to me, and let's keep you back on track. So The great thing is we literally see everything that the borrower has done to their existing lender or their servicing company, the hardship letters, the phone calls, the conversations back and forth with the servicing company calling them to try to figure things out. So that helps us in seeing the mindset. I mean, if you are calling the lender and say, hey, I'm in trouble, I need some help, I'm glad to work with that investor or that borrower, because if I'm buying at 50 cents on the dollar, it gives me a lot of flexibility to say, okay, what can you pay? I know you're a year behind. You may not have a full year of payments. Can you bring 4 months to the table? Can you pay a little bit extra per month to get called back up on stuff? Do you want to sell the property? Do we need to do like a short sale if you owe more? Do we need to list it? Give you some time to get out of it, or if somebody can come and take over the payments. So I joke that it's kind of like the when I was a kid, I liked reading those choose your own adventure books back in the day, where you'd read it and get to a question and one way you went to page 8, you went to page 12. It's kind of like that in a little bit. Like, okay, the borrowers have sent a letter what they'd like to do. Does that work? Or does plan B work? Or plan C work for it? Some people, it's literally like, hey, we need to give you cash to get out of the deal. Because there's no way the payment that you can't afford just doesn't make sense for where we're at with the deal or what's the market going on. And then let's work to get you out of the bad situation. I mean, that's one thing it's so important that people don't realize is that when they go to foreclosure, if they let it go to foreclosure, and I have to foreclose on that borrower, it's going to haunt them for 7 years in their credit. It's basically a death sentence. Late pays, being behind by 90 or a year, really only hurts them for 24 months. So if I can step in and say, hey, let's get you out of this deal, we'll give you some cash if you got a ton of equity, or get some cash to walk away so that we can speed up the foreclosure time frame for us. That in 2 years you do everything right, like you're supposed to be paying your bills on time, you'll be able to go buy a new house and get out of this American dream that's turned into the American nightmare for you. So that's just kind of looking at things. What are we into it for? What's their monthly payment look like? It's pretty easy to calculate. Okay, if we're buying it at 70 cents on the dollar and they're supposed to be making their P&I payment, just multiplying that times 12 divided by what we're paying for it, we can see if we're already in a ball game if the borrower just starts to repay on time. Because unfortunately, most borrowers don't know their options. Most lenders will want the borrowers to come to the table with a full amount that they're behind on. And if you're 12, 24 months behind and you've been sick or you went through divorce or out of work or whatever, you just don't have that. And then, like I said, that goes back to me empathizing with people from the time that I was facing that, facing the struggles. I don't mind working with somebody if it makes sense. If it doesn't make sense, then we need to have a come to Jesus meeting and go from there. And most people want to work 85, 90% of the deals we do. People are very, oh, thank you for the opportunity. This is awesome. I was so scared. thank you for working with me. And then you got a few folks that will try to take an inch and stretch it into a mile, trying to drag things out, foreclosures, lying. We've dealt with those folks, and those folks are kind of a pleasure to foreclose on when they lie to you. You know what I mean? I'm like, yeah, you shouldn't really be in a home. We tried to help you, but now this has drug on another 12 months because you lied to me and I've caught you in multiple lies. Let's just get this done.
Yeah. And I appreciate that explanation, because I think in my mind I was thinking a lot about this from the perspective of landlord needing to evict a renter, but this is really a very different ball game. And a couple of things occurred to me while you were talking about it. One, you sort of mentioned how much equity they have, because that is an interesting piece of it. Is like, go back to that $200,000 house, but if someone's paid off $100,000 or $120,000 of that, they still have the same payment. And so it's if you're able to then find some solution where maybe you stretch their remaining amount owed over a longer time, like they can actually keep their home. And I would think if you are buying these distressed notes from like big banks, like well-known banks, they're so rigid in their procedures that it's kind of funny. I mean, I've experienced it personally, just how rigid they are in their, they're like, we don't care what your net worth is. We care that you have a W-2 job that pays you X number of dollars. And it's like, well, what about the self-employed people or people that own businesses and they might have multi-million-dollar businesses or lots of real estate. And it's like, if you don't check the boxes, then they're not going to lend to you. And I would imagine that's going to be the same thing in these scenarios where if someone gets behind, they're like, we have one option, you pay all of it, or we foreclose on you. So is that what I guess that creates opportunity for you, and then therefore for the people living in those homes that you've purchased the notes for.
Yeah. So we'll throw out a couple names: Bank of America, Chase, Citi, Wells Fargo. Those are some of the biggest banks. We don't buy from them because they're so rigid. They don't want to sell a one-off or 5 notes. They want to sell 50 to 100 million at a time.
Gotcha.
And they're not selling at a price that really makes sense unless you got really, really cheap funds, money to do this stuff. Unfortunately, we have to raise private capital for these things from investors or own funds, stuff like that. I got to have cash to buy the stuff. But that still leaves, since there's 5,000 licensed banks across the country and almost 20,000 other lending institutions, there's still a lot of inventory out there from lenders that have smaller portfolios that we can buy from. Or, we buy a lot of one-offs. Biggest pool we bought was 700 notes at one time. So it's all about, yes, educate the bar. Here's your options. No Trump, no Biden, no Obama. Nobody's going to save you. You're responsible for it. You know what I mean? And then what can you afford? And does this make sense? And, sometimes it's a hard decision. Like, listen, I know, let me get you out of the property. But if somebody can pay on time for 12 months, like we'll do a lot of workout plans for them. Like, okay, let's put you on a trial payment plan for 12 months. If you do that and do well with that, then we'll stretch your term back. We'll add another 5 years onto it, or we'll modify the loan at that point. And that's actually a large aspect of what we do is if we can get a borrower to pay on time for 12 months, it really kind of recasts the loan. It requalifies the loan from a non-performing note to a re-performing note that if I bought it from, say, at 60 cents on the dollar from a fund, I could turn around and sell it back to Wall Street, back on the secondary market for 85, 90 cents on the dollar without ever having to rehab the property or anything like that. I might have some servicing costs. I might have some attorney fees along the way, but that's what we like to do is, hey, get people back on track, hold it for a period of time for cash flow, and then turn around and sell it back to the market and then double down and rinse and repeat. And it's all about the velocity of capital, as they say. And so that's what we try to do.
Yeah. Yeah. It just sounds like it does really provide a lot of flexibility in some of the things I've heard about note investing in the past. Like I said, it hasn't been a huge topic we've had on the podcast, but a lot of it has maybe pointed to, oh, you don't have to deal with tenants and repairs and all of that stuff. But I'm sort of hearing you say that maybe that's not entirely true, that you've still got to work with those borrowers. You may have to foreclose and then figure out what to do with that property. So it's not completely removed. I suppose if you're only operating in the space of performing notes, and you're literally just, you're going to may have lower returns, but potentially a little less of that, headache. I'd love to hear what you think.
You're 100% correct with that. We're usually not dealing with toilet stands and trash. That's like a lot of folks are. If you look at most apartments owners or landlords, they're seeing $200, $300 a month in cash flow, but they still have to be present. Everybody always loves the story about how the borrower called or your tenant called you on the 4th of July or Christmas Eve because the toilet's overflooding, right? Or the air conditioner broke in the middle of summer, right?
Yeah.
But we don't deal with that. They don't call us because we're the bank, and we actually don't have to talk to the borrowers that much. We use a third-party servicing company who's actually doing most of the borrower outreach. They're the ones sending out the statements, collecting payments. They're handling the licensing requirements to be a licensed debt collector in the different states out there. And so all we have to do is when we buy a note is then we put it with a servicing company or keep it with the existing servicing company and then tell our contact there, here's what we'd like to do with the asset, A, B, or C with a borrower. If the borrower comes back and wants to do something different, stuff like that, we'll review it. If they won't want to play ball, then I'm not going out and knock and collect, and then we will just bump it to a local foreclosure attorney in that state who will start the foreclosure process. And sometimes that's all it needs to get people back to the table is like, hey, this guy is serious. Okay, what do I need to do? And, we'll give people 60 to 90 days from the time that the attorney files the notice to foreclose for them to come back to the table. If it gets beyond that, I'm like, listen, calling me at the last minute or calling, showing up at the court trying to work something out is just not going to work because we've given you plenty of opportunities. But, you do have some rehabs, like this one in Georgetown. I know that we'll probably foreclose on it and have to put probably 10 to 20 grand in rehab into it. But it's a nice thing. So I'm making 40 grand at the foreclosure auction. We'll make 100 to 150 by taking the asset back and going from there. But if it sells at the auction, hey, it's still a good day for us. We can move on and go from there.
Right. Yeah. Makes sense. You mentioned raising private capital. What types of returns do you anticipate in this asset class for your investors? Yeah.
So we shoot to get if it's going to be a reperforming note, we look to see a 16% yield based straight off the cash flow. All right. And then we're offering up investors a passive return of 8 to 10% for 12 to 36 months. It's not a 30-year process. So we don't want to hold on to it for that long term for the most part. So that's what we look for. Now, if they've got bigger chunks of money, we'll come in and can do some syndications with them. We can do some individual deals with special purpose LLCs on that stuff and then kind of go 50-50 on the split stuff, depending on what the borrowers or what the investors' experiences, stuff like that. So, but that's what we try to shoot for: an 8, 10, 12% return for them. Like I said, for over, I think the longest one we had was 60 months on stuff like that. But usually it's a 24 to 36 month because the numbers just make sense for us to get them in, get them out, rinse and repeat, and go from there.
Yeah, yeah. No, that's great from a velocity of capital standpoint. On those returns. I wanted to ask you about, I guess, what you've seen in the market cycles. So, I would wonder in this space, you would think like times 2008 through 2012 were a lot of opportunity in note investing in distressed notes, and maybe these last few years again. Like what have you seen from a ebb and flow of deal volume and transaction volume? Like what's been your experience?
Great question. I get that question all the time. And it's funny, when I started doing this back in 2010, a lot of us that were into it, because it was really kind of, it's a niche that's really, you could always buy notes, but the distressed stuff really sprouted up in that 2009-10 area.
Sure.
And we all thought that we're buying distressed stuff, we'd have 4 years and it would go away. Well, that's dragged down. We still see non-performing notes from stuff that's being originated, where people had a mortgage 5 years ago and they defaulted. COVID caused a lot of people to default, stuff like that. You still see defaults taking place now across the country where people are having a hard time affording their mortgages. We do commercial notes. So you see a lot of multifamilies in distress these days too, So I don't think it's going to be as extreme. When you look back at 2010, there was 15 million homeowners underwater where they owed more on their property than what it was worth. I don't think we'll hit that. I think we're going to get probably halfway there with distress, just based on some of the numbers that you see with HUD and first-time home buyers really being the largest distress amount at about 10, 11% Those are in distress. You see what's going on in Florida with the condo markets and HOAs and stuff out there causing that whole market to be stressed. Insurance distress in the Gulf Coast and Florida as well. So there's a lot of different varying factors on stuff, but we are seeing an uptick in distress stuff. I'm not going to lie. When especially this time of year, I don't know when this is going to go live, but the fourth quarter and the first quarter of the year are always the busiest as banks are coming to that fiscal year end. And so what's surprising was 6 months ago, lenders started emailing me, calling me, hey, what would you bid for this? Or what are you looking for? 90% of the time, it's me reaching out via LinkedIn or an email blast or dialing for dollars to find the right people to get stuff. But when they start calling you, you're like, something's going on is interesting here. Yeah. So we're seeing more stuff. A lot of lenders have been waiting till 2026, where now they have to move it. They can no longer kick the can down the road. But it's funny. I see people like, okay, your bids are now accepted that we made offers like 90 days ago. I go, well, my bid's now faded and reduced by 10% because of things going on. So there's opportunity. There's always been opportunity if you know how to market in this space. Some folks that got into it earlier on, there was plenty of funds that were running around trying to sell stuff off. You didn't have to market. You have to market in this business. You know, you got to, like I said, LinkedIn is one of our number ones, email marketing. You know, our podcast actually draws in asset managers and bankers from time to time who are looking for buyers of their distressed stuff, which is kind of neat. So just that rinse and repeat aspect, like anything else. It's not as capital. You know, it's not such much capital invested like it is with direct mail or advertising, billboards, or commercials or stuff like that. Since we don't do any direct mail marketing because it's not going to get to the right asset manager. So, like I said, it's pretty inexpensive to find lists. You just have to understand it's a process of, like I said, 80% of sales happens over the fifth contact. You just got to follow up.
Yeah. No, thanks for. You actually preempted my next question, which was going to be about your marketing channels for these deals. So, I mean, I mentioned this before. I feel like, one of the coolest things about real estate is there's so many different opportunities. There's so many different ways to find a way to get involved. I think creativity is fostered with when there's more distress. As you said, it's now you're getting phone calls to you instead of you having to reach out, which indicates, unfortunately, problems for people, but also opportunity for you and potentially opportunity for that homeowner to have their distress and their note like restructured in some way so that they can get back on their feet and maintain their home. I think people, this, I guess I knew this intuitively, but this sort of opened my eyes even more. This conversation, like people, when they're renting, not paying their rent, maybe even getting evicted is like not fun, but there's not that like personal attachment to the space that they're living in versus, buying a home is a much more rigorous process. You're looking at it from an ownership perspective. So I think it definitely points to, kind of a different mindset, the mentality of that, whoever the note holder is, you want to, the idea that you get to kind of look back through the communications and have that be clear to you what that, homeowner is thinking in the process, I think is actually probably a pretty big advantage and something I would imagine you lean into pretty heavily. Or are you much more analytic about it?
No, I mean, you do both. You have to realize most people, their home, when they buy, it's going to be their biggest investment for the most part. But they've also got a lot of emotional equity tied up into it. In the down payment, they put whatever skin in the game. Yep. The school districts, the neighborhoods. Nobody wants to get foreclosed on and have a U-Haul truck show up the day with the sheriff show up. Nobody wants that, And so looking at where they're at, hey, what's the emotional? I mean, we do a lot of, like, say, social sleuthing as well. My team, we'll jump on Facebook and LinkedIn to see what people are doing. We've seen people who are like, what do I do? I'm facing, I'm like, okay, well, let's work with that person. Or you see any person, oh, I just went out and bought a brand new Cadillac. I'm like, I don't feel sorry for you. We're going to foreclose on you for sure. You know what I mean? Unless you can come to the table. So there's a bit of a mix of that emotional aspect of things. But at the end of the day, I'm a no, no nonsense aspect. We'll give you an opportunity. If you don't do these things,
Right.
I'm going to foreclose. There's no question asked about that. Like we have one lady in dealing Round Rock had a ton of equity. She was an older lady. House needed a little bit of work. We even listen, we bought the note. Why don't you go do a reverse mortgage? You can refinance out, pull some cash out, still live in the property. No, I don't want to do that. I'm like, okay, what do you want? I just want to really walk away. I'm like, well, we could give you some money to walk. Oh, that'd be great. I'm like, okay, that saves us from having to foreclose. We give her $75,000 cash, and she was happy as a lark. We still made 6 figures on the deal. Mm-hmm. But a lot of people are like, well, why did you just foreclose? You made a whole lot more money. Yeah, we would have. We would have made more money, but you got a lady who's, it's not her. I mean, she lives in this big house. Her husband died. Her kids don't live near her. Let's do some good. Right. Let's make some positive things happen. I mean, we bought a note a few years back where the lady, when we're doing our due diligence and collateral file, she'd been trying to modify her loan for 4.5, 5 years. Think about that. 4 to 5 years of being stressed out because her husband had a heart attack, couldn't pay the bills for a while. And we're looking at this, and she'd sent in her tax returns, her check stubs, her bank statements, handwritten a note every time, 4 times. And the note had just been sold and been sold and been sold. And when we were able to see that, okay, she says she could pay this monthly. Okay, that works for us. She could pay a little bit extra. That works for us. And when we're buying the note, let's just make this happen. One phone call, boom. 5 years later, she's paid off her mortgage that she lived in the house, raised her 3 daughters in for 18 years before everything happened. There's times that we just forgive debt too. Listen, let's get you back on track. You owe way more than the property's worth now. It's not your fault the market crashed or has dropped. So let's get you paying on time for 12 months, and then we'll recast the balance and forgive you $20,000 or $50,000 or $100,000 to where it's at legitimately right now, and make it a win-win for you. So I like the ability to be able to get creative with people. Mm-hmm. We get a lot of spreadsheets in, so we spend a lot of time in spreadsheets. I'm kind of like the Jason or the Christian Bale character in The Big Short. I'm looking at spreadsheets and listening to my headphones and podcasts all day long, drumming on stuff while I'm looking at stuff, and then okay, let's go with these 10 or these 20, and try to help make it a win-win solution. A win for us, a win for the borrowers, a win for the bank to get off their books, and then also a win for our investors too.
Yeah, oh, that's great. Also, a really good transition or segue into asking you the questions I ask every guest. The first one, of course, being the name of the show, is Know Your Why. So what is your why, Scott? You've touched on how this is, your business model allows you to actually help people and let them stay in their homes. But I want to, ask you the question directly and give you a little more chance to expand on it.
So there's 2 stories that were very life-changing for me. One, back in 2001, when I first ever got my loan officer's license. I got my insurance license, and in the state of Texas at the time, you could pay $125 to the state, and you could do loans. I mean, a lot of licensing requirements in Texas back then. It's different now. Yeah. But the first ever loan I did, Jason, was for my parents. I did a refi cash out. Their interest rate was at 17% still. They had all these credit cards. It was like they were in a canoe and the water was coming over the sides. Yeah. And I was able to refinance them, pull some equity out of their house, pay off their credit card, so that their house paid off in 8 years versus 30 years. And my dad cried at the closing table. And that was very impactful to me. I mean, it literally makes me, choke up right now. Yeah. That was a very thing. That's why I love the mortgage business, like helping people. And then facing the trials and tribulations I did a few years later in 2004. And I firmly believe God pulled my assets out of a sling for sure, helping me out with that. To the point where in 2008, when this opportunity presented myself to go back and start traveling and doing all stuff, I said, God, thank you so much. I said, and I just had this 4-year apprenticeship with my mentors to learn this note business, where I would take home different classes every week. I was like, let me help people. This is a great tool to win-win, make money and help people. And that's why I said, hey, if you get me through 2007, 2008, God, I'll definitely try to help as many people as that we can. And that's one facet of our business, is our education that we do, and helping other investors that either they want to, they don't want to leave their job. They like the job, but they want to make it some more passive income, or when they get their 401k back up and going, or they do not like their job and they want to become a full-time investor, but don't want to deal with rehabs or toilet stands and trash outs. So those are my whys for the most part, providing for my family, but also helping, as I joke, and this is not political, but making America great again, one distressed borrower at a time.
There you go. There you go. No, I thought businesses need to make money. That's why you would have a business. You don't go into business to lose money, but also at the same time, like the ability to help people at a such a significant, like their homeownership, like maintaining their homeownership, such a significant piece of their life is actually, I mean, kind of incredibly impactful. So I think it's super cool, and the creativity around it to me is one of the funnest parts. You know, I've said it a couple of times. Creativity, the ability, the many different ways you can come at this is just one of the best parts of real estate.
One nice thing I might add to that is people think you have to have millions and millions of dollars to do this business, like $5 million, $10 million. That's not the case. You know, we've had plenty of people that come in, you know, with 50 to 100 grand in their IRA, and they go buy a note or two that's going to give them a 12% return, and gives them all the confidence to go out and raise capital from friends and families to go do it. And so that's the thing is, most people, I got to have $10 million to do this. Like, no, you don't. I bought plenty of deals that were below 50 grand or below 75 grand that were great deals. It may not have been something I might have moved in myself. I mean, $70,000 might be a garage where you live, you know, 1-car garage. Yeah,
if
that would be a really nice house in Toledo. You know what I mean?
Yeah. No, it's I'm not even sure you could get a garage here for 70 grand, but it is. But no, your point is exactly right. The I guess ability to get involved in involved in real estate, find yourself an investment vehicle that's largely maybe more passive than whatever your income source is now. I mean, I think it makes a lot of sense. So I love it. What Scott, when people hear this and they want to connect with you, what's the best way for them to reach out?
Well, the first thing you got to do is make sure that you go over, if you're listening to this, make sure you leave Jason a 5-star review. All right, subscribe and leave a 5-star review, because we'll definitely put my thing. But it's easy. We have our main website, weclosenotes.com. You can go there, find out our different classes, our podcasts. I even cloned myself about 3 months ago, where I've got a fully AI clone that you can go pick his brain and ask questions of it, and he will answer back in my voice. And it's very, very good. I will tell you that. So weclosenotes.com. If you want to book a phone call and pick my brain, not my clone's brain, you can do so by going to talkwithscottcarson.com and book a call on my schedule.
Awesome. We'll get in the show notes. I got to check out your clone. I always find those things just so fascinating now. What people are doing with AI and
you know, it is amazing. I mean, I uploaded all our podcast episodes, my classes, my books to it, my blogs, and it asks questions. I mean, it's trained on my stuff, so as long as you ask it a question, it's on that stuff. It's pretty damn accurate for the most part, and it does it in voice or audio, text or voice. We're tweaking with the video side of it. I was just actually on an AI conference minutes before jumping on here, learning how to do a little bit better of that with my team, and it's good. But that's one of the big things. I like to help people answer their questions, and I like to have something that's 24/7 available to folks, because that way, if you got a question at 2 o'clock in the morning or 2 o'clock in the afternoon, they can go somewhere. They don't have to wait to talk with me, and it's going to be pretty damn accurate. I even did a podcast episode interviewing my clone a while back. It was pretty funny.
Oh, really? Check that one out. That's amazing. Well, Scott, this conversation was great. I really appreciate your time. I appreciate everything you shared with us. So thank you for being here. Thanks for taking the time out to spend with me today.
Thank you for having me. It's been an honor, Jason.
Folks, make sure you connect with Scott, and as he mentioned, please like, rate, and review the show. It helps us get more great guests, and as always, thank you so much for listening.
Hey there, I am Dr. Jason Balara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why?